Hello again and welcome back to London. Tesco is a UK supermarket heavyweight, but it has just checked in really awful results, posting one of the largest corporate losses in the history of the FTSE. I've been speaking to David Papier from ETX Capital about where it goes from here. We've had a bit of time to digest these Tesco's numbers that are worse than the markets were expecting. We also know that the likes of Lidl and Aldi are competing very strongly in this space, but why in particular are Tesco's numbers so bad?
Well, there's a few reasons for that. The 6.4 billion loss that they incurred yesterday has already exceeded the city's dire expectations of their results, and frankly there could be more to come. Now, this is due to an industry price war that's been created by the Big Four. It's due to a fall in value in their property, which they wrote down yesterday by 4.7 billion, and it's the acquisition of market share from the discount retailers such as Aldi and Lidl, and also Netto coming into the scene. And it's also falling footfall, where shoppers are moving out of the big in-town superstores and going to support local shops.
Yeah, but as I said, we know about those Lidl and Aldi factors. So are we going to see the same for Sainsburys and Morrisons in terms of seeing these dire results?
Well, I mean, potentially, yes. You know, it's not just Tesco's that have been had poor trading years. You know, Sainsbury's are the same, Morrisons are the same. You know, this is something that's been affecting, you know, the Big Four across the board.
So what happens now? I mean, Dave Lewis, it was a bit of an unknown when he came in. Do you think that markets will have faith in him?
I think the guy has track record. Okay, he turned around Unilever, has done a very good job there, and this is one of the reasons why Tesco's have brought him in. Now, you know, Drastic Dave has a plan for the fight back. You know, he's going to be lowering prices, he's going to be putting more staff on the shop floor, there's going to be more streamlined product ranges, and apparently better customer service. Now, what is quite interesting is the fact that they are actually looking to close 43 stores across the country, and they've actually cancelled 49 planned stores. So again, this is going to be saving costs for them. But as one of my fellow commentators said, the guy's job is like an ant climbing the Himalayas.
Yeah, exactly. And so, but are his hands tied by the amount of debt that Tesco's has? There's many interesting numbers out there. One was that Tesco's net debt is the same as its market cap now. Does that put it in a difficult position?
I think it does, absolutely. I mean, their net debt at the moment is standing at 8.5 billion, and there are a huge amount of measures that are going to have to put in place to try and, you know, resolve some of this debt issue. But the fact of the matter is, and I think what is going to worry investors, is that there is no indication that dividend payments are going to resume anytime soon.
What about consolidation in the sector? We've seen it in the commodity space where price pressures are also there. We've seen supermarkets also coming under a price pressure of their own type. Does this mean we're going to see some sort of consolidation? Potentially. Yeah. Well, my theory is Morrisons is looking vulnerable because especially they're very weak at online sales. Do you think Morrisons could be a target for one of these big guys? Well, look,
I don't think the acquisition of another supermarket or adding more stores or more products is going to help them. I think, yes, you're absolutely right. They need to consolidate. They need more streamlined product ranges. They need a better offering within their stores. They need to make themselves more competitive. And I don't think buying, you know, another one of the Big Four or adding more stores or cancelling stores is going to help that at all.
So let's finish off with the price action. As I was saying before we started this interview, I made the call, to my great credit, 6 months ago that Tesco's was a screaming buy because it's such a established brand. Do you think the markets are going to react positively to the news now we've got all the bad stuff out of the way?
Well, look, the fact of the matter is that the share price dropped to a low of 155p per share. Now, this year, the stock is actually up 18%. So any investor that were bought around that level has seen a return, especially when it got up to the highs. I think it was 234, 235. So, you know, Tesco's is a huge organisation. It's Britain's largest grocer. It's the third biggest grocer in the world. You know, there is opportunity here for investors to make money, but it's about getting in at the right time, and it's also about making sure that Tesco's do the right thing so their share price does increase and they do bring a dividend back for their shareholders.
Well, thanks to David for his insight into things. Stay tuned to Duke's Copy TV for more interviews and analysis, but for now, goodbye.